So, ladies and gentlemen, good morning to everybody. And let me thank very warmly Thea and Frédéric for the invitation to this very important panel in my capacity as president of ANIA, the Italian Association of Insurers and Reinsurers. So it is an honor to do so, especially at such a pivotal moment in Europe. I took up my role last December after having spent many years leading Generali's operations in Germany and then across the broader DACH region. And actually, in my career as an insurance manager, I have been active in several jurisdictions and in most European countries. And this journey has allowed me to broaden up my perspective beyond the national borders and towards the shared responsibility for our continent's future. It is this outlook that I would like to bring to you today in the debate. We are witnessing one of the most profound transformations in the global order since the World War II, and Europe is in its very center. The consequence of COVID pandemics, the ongoing conflict in Ukraine, and the October 7th attack in the Middle East with the terrible outcome in Gaza have shaken the foundations of our development model, changing assumptions about trade, about energy, about resilience. More recently, decisions by the US administration through a mixture of both announcement and actions, are reshaping markets, capital flows, and European regulation. I will share with you some very basic concepts. Some of you will be maybe disappointed, but I think they are basic and simple, but these are, in my opinion, the cornerstones out of which we as a European should develop our position against these threats we're facing. Because what it is at stake is not only growth, but the very foundation of Europe's model, its autonomy, its economic strength, its values and identity. Europe must draw forces from within, from its institutions, its citizens, and its shared purpose, but also, I would say, from its wealth, to confront these challenges with vision and courage, and to overcome the structural weaknesses holding back its competitiveness. Several indications, like the recent Letta and Draghi's two Italian reports, highlight Europe's competitiveness gap with the US and call for bold mobilization of public and private capital to support growth, jobs, and strategic autonomy. These reports are not just proposals. They are actually urgent calls to action. As the Italian President Sergio Mattarella recently said, it is urgent that Europe acts. Standing still is not an option anymore. The von der Leyen Commission has begun addressing these priorities, notably through smarter regulation and the launch of the Saving and Investment Union policy. And this is a step in the right direction. But this step must now become a leap, actually a leap, as pressure on trade, defense, and investments continue to rise. All of this forces us to rethink the foundation of our economic and strategic posture. Let me point out four key facts that frame today's discussion. The first point is Europe's growth still lags behind more dynamic economies, and notably the US, due to persistently low productivity. Productivity is the key word. This gap, which opened at the end of the last century, has widened with digital and technological advances. Bridging this gap requires stronger and more resilient growth to meet demographic, ecological, and digital challenges while delivering prosperity. In other words, and very prosaically, it requires large investments. The second point is the European Commission's Competitiveness Compass rightly highlights an innovation deficit as a key obstacle. So we do have a productivity gap to be filled, and this gap should be filled through innovation. Compared to US and China, Europe must do more to foster technological adoption, entrepreneurial risk-taking, and access to finance for innovative businesses. The third point I want to mention is that savings is not actually an issue. European households, and notably Italian households more than that, save much more than Americans. The real challenge is channeling these savings into productive investments to the advantage of real economy. As a fourth point, I would like to mention that our financial system is actually not very well equipped for this task. It is overly reliant on banks, underuses institutional investors, and it is constrained by household risk aversion and capital rules that penalize long-term investments. And when I say long-term, I don't mean 5 years. I mean 10, 20, 30 years investments. So what role can insurers, what role can we play in addressing such challenges? I would say a very significant one. First of all, the life insurance business is by definition an investment business, and it can directly and positively impact the European transformation. Our sector is strong, resilient, and trusted by millions of European citizens. That trust has enabled us to gather and manage close to 10 trillion euros in assets, making insurance of one of Europe's largest institutional investors. Around 70% of these 10 trillions of assets are invested in European equities, bonds, and sovereign debt. Sorry. Well, it is very natural then, if this is the situation, that we are expected and asked to do more, particularly when it comes to supporting the real economy, fostering innovation, and financing the green and digital transformation. In this context, the launch of the Saving and Investment Union is a welcome and important step. As a matter of fact, though, it must be pointed out very clearly that life insurance follows a quite different dynamic than regular asset managers. Recognizing these differences is essential to shaping a regulatory framework that enables insurers to contribute fully to Europe's strategic objectives while respecting the specificities and the rules of our business. This is a very important concept. Our investments are closely linked to the commitments we make to policyholders. They are not just about returns, they directly support our core mission of assessing and managing risk on behalf of our customers. Returns, risk, and durations must always match our liabilities. In order not to jeopardize our operating model, aligning the assets allocation with the liability profile must be a dogma. Once again, very simple concept, but in my opinion, a very strong one when we have to develop a strategy going forward. This is why, for example, I see very limited technical possibilities for life insurance to support investments in the defense capabilities directly, as somebody has recently proposed. On the other hand, I can see an enormous potential for engaging in infrastructure, innovation, and energy transition investments. On this topic, let me spend a couple of words. Even if ESG may seem today less fashionable, so to say, we must reaffirm the central role of sustainability in our investment decisions as insurers. The concept of ESG is embedded in the DNA of insurers, whose business model is inherently a very long-term one. It remains vital to our industry and should be actively promoted through both supportive regulation, like the recent Omnibus initiative, and capital reliefs that reward long-term sustainable investments in this area. I was talking about investments in innovation, and as far as investments in innovations are concerned, they find particularly fertile ground in the asset allocation strategies of an insurance company, thanks to their natural inclination to operate with long-term horizons and the growing need to diversify portfolios. So the nature of the liabilities of an insurance company, combined with adequate and conducive regulatory environment, can drive industry players towards investments that offer a balanced combination of risk-adjusted returns, stability, and compliance with capital constraints, and at the same time foster what we need. So, technological and industrial innovation, digitalization, artificial intelligence, and the energy transition, thus generating the sustainable growth and value over time that we in Europe are lacking for. On top of what I said, insurers are by nature also experts in managing risk, not only in investing money, but in managing risks, and notably in P&C insurance. We are born as insurer to protect individuals and firms from shocks and uncertainty. The basics of our protection business, reducing the perceived risks of families and firms, make us a powerful force in shifting their short-term defensive savings into long-term investments in the real economy, unlocking capital which is currently kept available in a less efficient way. This is a side which is normally not so much explored, but I think it is worth mentioning it, because as institutional insurers in life insurance, we can play a role, but as long as we increase the level of protection of families, households, and firms in Europe, we are also reducing the necessity of keeping savings on a short-term bank account in order to face potential risks. Any initiatives aimed, therefore, at sensibilizing and nudging European citizens and firms to use insurance as a tool to control risks will free up capital and savings, which will end up by being invested in strengthening the European transformation. To exploit the full potential of the investments related to insurance and to use insurance as a powerful engine for long-term transformation of our continent, a number of key decisions are needed, though. Let me briefly highlight a few of them, which I hope we can explore further in today's discussions. First, within the Savings and Investment Union framework, long-term savings should be actively promoted, once again, I believe 5 years is not a long-term saving. I believe we need a longer period of time to define savings in the long term. And they should be actively promoted through clear benefits for investors and policyholders that reflect the illiquid risk, of course, the illiquid nature of these products, preferably linked to ESG investments, whose regulation should be actually simplified, by the way. Flexibility for investors through defined exit windows can be allowed without compromising, in any case, the long-term perspective, and national incentive schemes must be fully aligned to the SIU objectives. The second prerequisite which I see important is I believe it is essential that insurance-based solutions are explicitly and strongly included within the scope of the proposed European label for long-term savings products. There is a tendency to see long-term savings as a financial product. Yes, of course it is, but there are some specificities of our business which make insurance the perfect candidate for such long-term savings and investments. Third, moving to a broader perspective, I would say that after a year of intense regulatory activity, it is high time to focus on simplification. I'm not saying that we should deregulate. Regulation is a good thing, but simplification of over-regulation is also a very good thing. New requirements should be avoided and existing ones streamlined to ease unnecessary burdens. The European Union must now adopt a true less is more approach, especially in key initiatives such as the retail investment strategy and the financial data access proposal. While we welcome the Commission's stated commitment, it is actually now time to turn intentions into concrete actions and deliver tangible results for the business community and for insurers in particular. As a fourth point, I'd like to mention the Level 2 implementing rules under the Solvency II review. They should stick to the and they should remain fully aligned with both the letter and the spirit of the political agreement reached last year. There is a discussion going on. I believe that what we agreed should be maintained, and this is particularly crucial for the treatment of long-term business, especially in areas such as long-term equity investments, the risk margin, and the volatility adjustments, and with specific attention to the risk correction and extrapolation. Finally, insurance-based public-private partnerships must be strengthened across a wider range of areas. From NatCat protection to public-private combinations in pensions and health schemes, long-term care for elderly people, and other important topics which indirectly will make Europe's socio-economical system more resilient and stronger to face the challenges I mentioned in the beginning of my speech. And therefore, we need a policy who should nudge households and firms to use the instrument of insurance protection to reduce the perceived environmental, demographic, and welfare risk of European citizens in order to free up short-term savings to the benefit of long-term investments, financing, the European transition. In short, the success of the Savings and Investment Union, and more broadly, of Europe's transformation, rely upon the active contribution of our industry. To fully play our part, though, we need the right conditions: a level playing field, a stable, predictable, and conducive regulatory framework, and a business environment that genuinely rewards long-term commitment. We're living in a world of uncertainties, volatility, risks, worries, fears, etc., etc. But let me close with a note of optimism, which resonates very much with what Thierry was saying before. Today's global landscape is complex and uncertain, but each crisis offers an opportunity. And after all, over the last 200 years, the insurance industry and the reinsurance industry has gone through times much worse than those of today. Insurance, thanks to their own resilient and risk-mitigating business model, are best equipped to step up, invest, and innovate in order to support Europe's sustainable growth in such a very difficult socio-economic and political moment. I am confident that today's discussions will offer valuable insights on how we can meet this challenge and the policy and regulatory choices needed to unlock this full potential which we do have in our business. Thank you very much.